Let's get oriented. I'm Lázaro Ulloa, owner and founder of Ulloa Financial, and this is your market compass for the week ahead for Monday, June 15th, 2026. And as we begin this week, investors are navigating a market shaped by four major pressure points: inflation, treasury yields, energy prices, and geopolitical risk. At the same time, one historic event has captured the attention of Wall Street and Main Street alike: the SpaceX IPO. The central question investors are asking is whether economic growth can continue while inflation remains elevated, energy markets remain sensitive to geopolitical developments, and the Federal Reserve enters a new era of leadership. Major indexes finished last week higher despite periods of volatility. Investor optimism surrounding artificial intelligence, productivity gains, and continued economic resilience help support risk assets. However, beneath the surface, the bond market remains cautious. Treasury yields continue reflecting uncertainty regarding inflation, future Federal Reserve policy, and the sustainability of current economic growth. One of the biggest financial stories of 2026 unfolded last week. SpaceX began trading on the NASDAQ under the ticker SPCX, completing the largest IPO in history. The company raised approximately $75 billion, and shares surged roughly 19% during their first day of trading, reinforcing the market's continued appetite for innovation, growth, and long-duration investment themes. Why does this matter? Not because investors should rush out and buy SpaceX. It matters because it provides a valuable window into investor psychology. When investors are willing to commit enormous amounts of capital to a company whose growth story extends decades into the future, it signals confidence in innovation, productivity, and long-term economic expansion. History teaches us that enthusiasm and valuation are not the same thing. The SpaceX IPO demonstrates that markets continue rewarding companies perceived to be shaping the future. At the same time, elevated expectations create elevated risks if those expectations are not ultimately fulfilled. Markets often become optimistic near major milestones. That does not mean optimism is misplaced. It simply means expectations become increasingly important. For long-term investors, the lesson is not to chase headlines. The lesson is to understand what those headlines reveal about overall market sentiment and risk appetite. Turning to inflation, data suggests price pressures remain above the Federal Reserve's long-term target. Consumer inflation remains above 4%, while core PCE inflation continues running above 3%. Those numbers suggest that while inflation may have stabilized, it has not normalized. That distinction is critical. The current market thesis remains centered around the soft landing narrative. Investors continue betting that inflation gradually moderates, economic growth remains positive, corporate earnings continue expanding, energy markets avoid major disruptions, and the Federal Reserve eventually gains flexibility to ease policy. These assumptions continue supporting current market valuations. However, investors must remember the difference between stabilization and normalization. Stabilization means conditions stop deteriorating, while normalization means inflation, interest rates, supply chains, labor markets, and economic conditions return to historically healthier baselines. Markets appear increasingly confident that stabilization is occurring. Normalization, however, remains uncertain. This week, the spotlight shifts to the Federal Reserve. The Federal Open Market Committee meets June 16th and 17th. While investors broadly expect the Fed to leave interest rates unchanged, this meeting carries significance far beyond the rate decision itself. This marks Kevin Warsh's first FOMC meeting as chairman of the Federal Reserve. Investors are not simply looking for policy decision. They are looking for a policy framework. Markets will be listening closely for clues about what a Warsh-led Fed Reserve may look like. Will monetary policy communication become less resilient on rigid forward guidance? Will the new leadership favor greater tactical flexibility? Will future rate expectations be communicated differently than they were under previous leadership? Chair Warsh's comments regarding inflation, labor market, economic growth, and the future direction of monetary policy may unlikely have a greater impact on markets than the rate decision itself. For now, however, markets largely expect the Fed to remain on hold, but the tone of this week's meeting could shape expectations for the remainder of 2026. So the week ahead. Additional economic reports scheduled for release this week include retail sales, housing data, weekly jobless claims, manufacturing data, and import and export prices. Retail sales will likely be the marquee economic report outside of the Federal Reserve meeting. A stronger than expected reading could reinforce confidence in economic growth, but it may also increase concerns that inflation remains persistent. A weaker report could reduce inflation fears while raising concerns about slowing economic consumer activity. Either outcome could influence Treasury yields and equity valuations. Investors should also be aware of quadruple witching on Friday, June 19th, when stock options, index options, stock futures, and index futures will expire simultaneously. These events can sometimes create elevated trading volume and short-term market volatility. On the geopolitical front, investors continue monitoring developments throughout the Middle East. Particular attention remains focused on the Strait of Hormuz, one of the most important energy checkpoints in the world. A significant portion of global petroleum shipments move through this narrow passage. Recent diplomatic developments have raised hopes that energy flows may remain stable and that tensions could continue easing. However, stabilization is not the same as normalization. Markets are currently responding to improving conditions and reduced disruption risks. That does not necessarily mean long-term geopolitical risks have disappeared. Why does this matter financially? Because geopolitical risk follows a powerful transmission mechanism. Geopolitical conflict leads to higher energy prices, which can lead to higher inflation, which can lead to higher treasury yields, which can ultimately affect market valuations. Energy remains one of the most important transmission channels between global investments and financial markets. Even though crude oil prices have recently eased on hopes of diplomatic progress, investors should continue monitoring developments carefully. So what does this mean for you? For investors with higher risk tolerance, opportunities continue to exist in sectors benefiting from innovation, artificial intelligence, productivity gains, and long-term economic growth. However, elevated valuations leave less room for disappointment. For investors with lower risk tolerance, this may be an appropriate time to revisit liquidity, fixed income allocations, diversification, and overall alignment with long-term financial objectives. The goal is not prediction. The goal is preparation. The purpose of Market Compass is to help investors remain informed, disciplined, and aligned with thoughtful financial plans regardless of market conditions. So stay focused, stay disciplined, and as always, stay oriented and elevate your legacy.